Have you come across beta when you're looking up stocks and been wondering what it means? What exactly does a beta of a stock tell you, and how can you use it to your advantage? All of these topics and more covered in today's video. Hey, welcome to Rhinance, the channel centered around your financial education to help make you a better investor. If you find my videos helpful and want to see more, be sure to subscribe as I upload new investing videos every week. So what exactly is beta? Beta is a measure of volatility, or risk, for an individual stock. It tells you how correlated the stock is with the market average and gives you a better idea of how volatile the stock will be when compared to the market. Stocks with a higher beta means they are more volatile than the market, and stocks with a lower beta means they are less volatile. To find beta, each stock will be compared to a market index to understand if it moves in tandem with that index or not. Usually, the S&P 500 is the main market index used for beta, so it is a benchmark in which stocks are compared to. The Greek letter beta is often used to represent beta, so if you see the symbol, that's what it means. Great, so how does this work then? Well, remember beta is a measure of how much a stock moves relative to the index. It can be thought of as a scale in which a beta of 1 is the midpoint. A beta of 1 represents a perfect correlation with the stock market. That means that whatever the index does over a given period of time, the stock should have the exact same movements as the index. Now, when you have a beta greater than 1, that means that the stock is more sensitive than the index. So if a stock has a beta of 1.5, for example, that means that for every 1% change in the market average, the stock itself will move by 1.5%. Likewise, when you have a beta of less than 1, the stock is less sensitive than the index. So if the stock you're interested in has a beta of 0.7, that means for every 1% move in the market, the stock will only change by 0.7%. It's also important to note that this relationship reflects both positive and negative changes in the market. So for that stock that had a beta of 1.5, if the market has a day where it loses 1%, you can expect the stock to also decline, but it will decline by 1.5%. Something else that's interesting about beta is that you can have assets with a beta of 0. For assets that have a beta of 0, that means there is no correlation whatsoever between the asset and the stock market. Cash is often regarded as an asset with a beta of 0 because the amount of cash you have in your bank account has nothing to do with how the stock market performs. Another interesting asset here is Bitcoin. Regardless of your views on crypto, Bitcoin actually has a beta of 0, meaning that the changes in Bitcoin have no correlation whatsoever with the changes in the stock market and vice versa. Lastly, assets can also have a negative beta. Although this may be counterintuitive at first, it just means that the asset has an inverse relationship with the stock market. So when the market is up, the negative beta asset is down. Gold is typically used as an example of this. When the stock market is in a bull run, gold is usually losing its value. But the opposite is true as well. In times of recessions and stock market declines, gold usually shines as an asset that will perform well in these periods. Before we end off this video, let's do a quick example with how you can see beta at work in the market. Let's have a look at two different stocks, Home Depot and Apple. For Home Depot, they have a beta very close to 1. Meaning that their stock price should move very closely with the market. We have a chart here in which green is Home Depot and red is the S&P 500. So when you compare the price action of Home Depot compared to the S&P 500, you can see that Home Depot has some variations, but most of the time it's just going up and down in tandem with the market. Now let's compare that to Apple. Apple has a beta of 1.25, meaning that the price changes in Apple should be more pronounced than the changes in the market. Once again, we have Apple in green and the S&P 500 in red. As you can see here, with Apple compared to the S&P 500, the moves are similar, but the moves in Apple are of greater magnitude than the S&P 500. Remember that beta is an average, so on green days, Apple usually gains more than the market, but on red days, Apple usually loses more than the market. Thanks for watching today. What are your thoughts on beta? Do you prefer to invest in stocks with a high or low beta? Do you have any 0 or negative beta assets in your portfolio? I'd love to hear your thoughts, so drop me a comment with how you use beta in your portfolio. If you learned something new today, give the video a like. You can check out the playlist on screen now for more stock market education videos. And as always, subscribe for more, and I'll see you in the next one. Bye!